Hey, welcome back to That's Why TV. Today, we're talking about government bonds. They sound boring, but trust me, they're actually super important. By the end of this video, you'll know what they are, how they work, what the secondary market is all about, and the pros and cons of government bonds. Before we begin, I also have a membership. If you sign up, you get early access to next month's video. It's only a few dollars or pounds, the price of a cup of coffee. Link in the description. And don't forget to subscribe and hit the bell icon so that you never miss a new upload. Let's get to it. A government bond is basically an IOU. When a government needs money, say for roads, schools, or even the military, it usually raises this money through taxes. But sometimes governments don't get enough from taxes, so they borrow from people, individual investors, and institutions. That's where bonds come in. If you buy a government bond, you're agreeing to lend the government money for a set time or until the loan matures. In return, they promise to give you steady coupon payments, which are small payments of a fraction of the bond, maybe 5% of the price you bought it for. They also promise, when the bond matures, to pay you back the original amount you lent them, or the principal. In other words, you give them a cash lump sum now, they give you a promise to pay back more later. Different countries call government bonds different things. US Treasuries, UK Gilts, whatever, but the principle is the same. Here's a quick example. Suppose a government wants to build new freeways, but doesn't have enough cash from taxes, so they issue some bonds, say $1,000 each, for 10 years with a 5% coupon rate. You buy one. The government gets its $1,000 to fund the new freeways, and every year you get the 5% coupon payment worth $50. Some bonds pay regularly, some only at the end, but the idea is the same: steady, predictable income. At the end of 10 years, you get your $1,000 back. If you're finding this interesting, I've put a reading list in the comments. If you pick up a book, I get a small commission at no extra cost to you. Okay, now let's go a bit deeper. Most people don't actually buy bonds directly from the government. Big institutions, like banks, usually scoop them up first. Then they sell them on to investors, you and me, on what's called the secondary market. This matters because bonds aren't just buy and hold. You can trade them, just like stocks. Let's go back to our $1,000 government bond, paying $50 a year in coupon payments. After 5 years, you decide to sell it. Maybe you lower the price to get people to buy it. Let's say you sell it for $950. Why would you sell for less than what you paid for it? Lots of reasons. You want quick cash, you found a better investment, maybe stocks or real estate. Inflation is eating away at your bond's value. Or interest rates have gone up, meaning that putting your money in the bank now pays more than your bond does. So, you decide to sell your bond. But then, why would anyone buy your discounted government bond? Because buyers don't care about what you paid, they care about what you're paying. That $50 coupon compared to a $950 purchase price means their coupon rate is now 5.26%, higher than 5%. They're getting the same $1,000 government bond, just cheaper, with a better percentage return. That's why people buy government bonds on the secondary market, because sometimes they're bargains. Now, let's take a look at the pros and cons of government bonds. Firstly, for governments. On the pros side, bonds give governments big lump sums to spend right now on infrastructure, healthcare, defence, whatever, without having to wait for taxes to slowly trickle in. On the cons, if governments borrow too much, debt repayments eat into their budgets. Some countries spend more on bond coupon payments to investors than on schools or the military. Now, let's take a look at pros and cons for investors in bonds. When it comes to the pros, government bonds are safer than stocks. Countries like the US or the UK almost never default, so you're very likely to get your money back on top of the coupon payments. They're also less risky than corporate bonds. Companies go bust more often than countries. For cautious investors, government bonds are a steady, predictable income stream. When it comes to cons, firstly, there is the fact that returns from buying bonds are usually lower than stocks or real estate. Furthermore, inflation makes your fixed coupon payments worth less over time. Times of high inflation often lead to central banks increasing interest rates to slow down the economy. When this happens, government bond prices fall because investors react by selling their bonds, knowing they can get better returns from just leaving their money in the bank. This means that if you want to sell your bond early, you'll get less money than what you bought it for. Finally, if you buy government bonds from less stable countries, there's always the risk they just don't pay you back. Government bonds are mostly safe, but not magical. They're just one tool in the messy world of investing. To sum up, government bonds are loans you give to governments in exchange for steady coupon payments and repayment of the original amount loaned or the principal when the bond matures. They're simple and mostly safe, but they come with trade-offs, both for governments and investors. Please like my video and let me know what you thought of the video in the comments section. Remember to become a member, you'll get access to next month's video early. Thanks for watching.